Hi, this is Randy Finney with Right Side of the Chart, and this is a closing market wrap for Thursday, April 13th, 2023. What I'm going to do in this video is a brief update on the equity markets. We'll look at QQQ, the NASDAQ 100 futures, SPY, the S&P 500 futures, and then the other kind of that whole loop or negative feedback loop, if you will, between interest rates, inflation, and the stock market. So that'll include, we'll do a brief update on ZB, the 30-year Treasury bond futures, DJP, the broad-based commodity ETF, the euro, and then just a couple commodities to show you that loop is certainly in play right now. All right, starting out with the equity markets, pretty good day in the NASDAQ, almost 2%, 1.9%, but technically insignificant day. In fact, remember we hit support yesterday. We hit the, I'll get to that in 1 second, on Apple and some of those big market leaders right on their Apple being, of course, one of the biggest components in the NASDAQ 100, right on the uptrend line. And then you had yesterday QQQ. So I'm going to zoom in here, just going to recap. We put in divergent high there. We had sell signal 1 on the minor trend line break, sell signal 2 on the break and back test, and we've been locked in this range, bouncing around. Say what you will of it. Every time you go down, might feel bearish. Every time it goes up, I'm sure it feels bullish. Every time it goes down, bearish. Today was up, but we're right at the top. If anything, we're a slight bit above that 318 level right there. I'm going to round that number off because I was referring to it as 318 today. It's virtually right there. I had it 317.96 or whatever. So we're right there, but we're also at resistance on the NQ futures. I told you I use multiple time frames, and I look at both the S&P 500, NASDAQ 100, as well as the ETFs and the futures. I'm going to show you those in 1 second. So just like yesterday, we had a slight pierce. As I repeatedly say, to break out of this range, the breakout will come on a definitive break, or the next sell signal will come on a definitive break and solid break and or 60-minute close. Like I say, the redder the better. So we had a little pierce down through there, just like we had a little pierce there, slight pierce today. And remember, tomorrow the big banks report, the leader of the sector, JP Morgan, I think Citibank's in there. You've got a lot of financials from here on out reporting, and we'll see where the market goes from there. So again, pretty much a non-event. The market's building energy like a coiled spring here in this little trading range. It's going to break one way or another. You know which way I think it's going to break, but you need that sell signal, and the next sell signal, that is, and that would be again a break of those recent lows. Looking at the daily chart, as I've said recently, this is, in my opinion, the best single best bearish setup I've seen at least all year. Certainly negative divergence on the daily chart of QQQ, and that divergence was confirmed 2 days ago. By confirmed, that's my definition. When you make an actual PPO crossover, a bearish PPO crossover that effectively puts that lower low in, a lower peak in the indicator. You can see it down there, and when you pop up the histogram, despite today's nearly 2% gain in QQQ, you still have that crossover very much in play. It's not a whipsaw or anything as of this time. Now we keep going up, sure, then you're going to turn the histogram green, and it's going to prove to be one of these little whipsaw signals. Other than that, I'm still looking and expecting to see a trend change, just like that one, just like that one. You can see the red hills, and just like that one. Actually, I'm looking for something closer to that one, a bigger leg down. And again, we need to throw in that final ingredient, which is the next sell signal, both on the indexes. There's QQQ. Let me just show you NQ real quick. That's the 10-minute chart. Here's that 60-minute chart. This is our resistance support zone right here, these yellow lines. Very important. Comparable, this one here at 12,973, as I pointed out recently, is comparable to that bottom of that trading range in QQQ that we need to break. And so I'm going to zoom in, and you can see the same thing here. As I just said a minute ago, this is really was support right there. We broke it, and it is support once broken becomes resistance. Same level I've been highlighting for the last few days, at least a week or so. 13,203 roughly, and you can see there it is. It's just like that. It is that same trading range in QQQ, except your, Nasdaq 100 futures, they'll trade around the clock, so you have these different reaction highs and lows, and we're right there. We didn't even take out the level, we closed right on it. So same story as I said earlier today. There are two objective ways to short a security, and you either short a break of support, which in this case will be 12,970 right there, give or take, or you can short a rally into resistance. If we break out, yeah, that's going to be bullish. If it's anything more than a whipsaw, whipsaws are almost to be expected in this market. The one thing I will point out, we are coming off that big divergent high. Remember, pretty significant sell signal in the Nasdaq, awaiting the next sell signals. We had the break of the trend line there, the back test, and again we've been moving sideways since. Divergent high right there at the highs recently, so we're still well below that divergent high. I do notice some positive divergence here now on the 60-minute chart. Yeah, that is, it has to be acknowledged. It could play out. It could, play out for the next leg up. These bullish divergences and negative divergences are a big part of my trading. That was a divergent low right there. Got that rally. Then you put in another divergent low right here at the bottom, and that was good for this rally so far. Now, we're also coming off a much larger, powerful divergent high. And when you step back out, which I already showed you on the daily chart, you have that much, much larger negative divergence there. And in my opinion, that will override. This could certainly play out for a little bit more, but ultimately, until and unless those divergences are taken out on the daily chart, then I'm still looking for a considerable leg down to come. That is the Nasdaq 100. When we look at the S&P 500 via ES, we do not have any positive, aka bullish divergence on the 60-minute chart here. These are the futures, ES, S&P 500 E-mini futures. You had our divergent low right here. That low, we've been walking up, put on another one there, and along the way we had little divergent highs. These are the swing trading. This is a swing trading time frame. So most recently, we had a little wedge here, right there. It's pretty clean up trend line, nice little divergent high, and we had a sell signal, broke down, hit this support right here. So the levels, what I'm showing you are what I believe to be the key levels, a couple of them. All the blue lines I'm drawing right now. Let me clear it out and redo that for you. So just like I said on Q and QQQ, we're watching the bottom of the trading range. Even though it's not as well defined on ES, the S&P 500, I would say this is the number to watch. That's the one you want a price alert set at. You know what, I'll do it right now. Set an alert, attach alert, alert outside of regular trading hours. And so you have a couple things. First of all, the first sell signal will come on a break of the uptrend line right there, 60-minute uptrend line on ES. You had a divergent high there, and you certainly had a correction once you get the sell signal. The sell signal was a break of support, and all the ES has done is put a marginal new and even larger. It extended the same divergences that were in place are now even bigger without any positive divergence. We roughly made an equal high right there to that yesterday's peak. And we could, if we go any higher anytime soon, you're still going to have negative divergence. These indicators are lagging that much. And so let's see if the big banks set the tone. They certainly have the chance to put a dent in the bearish case if we go much higher. But as of now, again, no technical change. Remember yesterday, and I made it very clear on that post, those sell signals appeared imminent and looked likely, but they were still, as I said, support is support until unless broken. So yesterday was simply a test of support on both the Nasdaq 100, QQQ hit the bottom of the range, NQ hit the bottom of the range, ES hit the trend line, SPY, the S&P 500 tracking ETF, there it is on the daily right there, that same uptrend line. That's what we're looking at here. There was a larger uptrend line here that was broken. 60-minute chart, you can see it right here. That's the level I gave you yesterday. That's again the big level to me. and that's comparable to what I just gave you on ES. So I already set the alert on ES. I think I have one set here. If not, I'm going to set it. 406 should do the trick. It'll take out this uptrend line. You can see the divergent high is only larger today than it was yesterday, and still very, very much intact. So I know I see things a lot different. I've seen the comments, the bull, starting to get this little kind of almost a crescendo from cries of those that are bullish, and great, more power to you, but the market's really gone nowhere now for the last couple of weeks. We made a slightly higher today, and like I said, this setup is every bit as intact, even better now than it was. Its divergences are even larger, and I still think it sets the stage for a much bigger drop. But if we start going up or continue going up, and then things like this happen, you take out the divergences, and then it gets harder and harder to make that case. Apple's the largest component, or teeter-totters lately, I guess, with Microsoft and QQQ, but of SPY and QQQ. And remember, yesterday was simply, as I said, just like QQQ was at support in that bottom of that recent trading range, Apple hit that very well defined uptrend line right there. So you have this large wedge. This is a 60-minute chart, and the divergence continues to build. And what we need are those next sell signals, and that's going to be a break of, if QQQ moves back to the bottom of the recent trading range, just flip back there, and takes out yesterday's low, then Apple should also follow suit and then take out the low, which means it'll take out this trend line. So that's what it looks like on the 60-minute chart. There's a daily chart. Again, no guarantees it'll play out. It is this is a trade setup. It's not an actionable trade. Apple is above trend, and as I've said it, a lot recently, if you are bullish, buy pullbacks to support. And if you are bearish, you can either short rallies into resistance. In the case of Apple, that would be that trend line, the primary downtrend line, like you hit there and got rejected the other day. That would be one objective level. And you always have the odds are higher in an uptrend. I'll just say this. The odds are higher when you short a break of support than they are when you short a rally into resistance, because you're in an uptrend. What usually ends an uptrend is a break of support when you have a clean uptrend line or something like that. Like right here, there's a great example of that. Boom, there's another really nice example. Steep uptrend line, one red candle, never look back. Trend line right there, trend line break, never look back. So divergent high, you didn't have divergence on the rest, but you had these bearish PPO crossovers, what I call high-level bearish PPO crossovers that came right around the top and accompanied these breakdowns, these sell signals. And there it is. You had that bearish PPO crossover, as I mentioned. Oh, no, we had it intraday. Oh, yeah, it is. It's intact. Never mind. We had it 3 days ago. That was the day I highlighted it, and it's still there. You still see the histogram is red. So again, as much as I would like to tell you otherwise, that I've flip-flopped and wow, the market's strong, Apple's up 3.35%, technically nothing's changed. We need those next sell signals, and they'll be big ones in my opinion if and when they come, because everything's lining up. You have the support on QQQ, Apple, and by the way, this is a BOD kind of nail in the coffin level on Apple. 157.50. I think I've already mentioned it, but the trend line's up here. Trend line will go first if and when it goes, and then you have really good support there, right there. Really good support. I mean, these were major reaction highs in the bear market. Successful breakout back test, and so if we fall back down solidly down below 157.50, that's going to be just like the stock market. This whole thing will prove to have been a false breakout, and in my opinion, probably the most powerful bear trap. Nope, I'm sorry, bull trap. If this happens, QQQ does it as well, SPY, and what I want to see on those, I want to see the 200s get taken out on QQQ and SPY. If that happens, that will set the stage, I think, for that 20 to 30% drop I'm talking about. If it doesn't happen, you remain above the 200s, well, then that's, you don't have a massive bull trap. So those are the levels to watch. Let me make sure I covered everything. Yep, I did on the markets. And then told you recently since this one's taken a while to play out, and I like to always hedge up, I'm using indirect hedges such as ZB. Where is that? ZB are your 10-year Treasury bonds, and that continues to play out. This one was based both fundamentally and technically. Fundamentally meaning if the market rallies, you're short, then Treasury bonds, they don't have that flight to safety bid. Treasury bonds, they don't always have it. It's been an on-off, but historically you've had that much more on than off. Meaning when the stock market's rallying, especially high risk stuff like tech stocks and things like that, crypto, that's when it's risk on market. And a risk on market means institutions are usually selling safe treasury bonds, and so that's worked so far. You can see ZB continues to move down, and that's after putting in that big divergent high. Just like you had a divergent high here, you got that divergent high here, you got that, and so anyways, that's playing out to help offset any losses or give backs in the short trades. And then let's move into commodities, and we'll wrap it up. And this one will be a relatively short video. EUR USD. So kind of been not all over the place on this. Called it this correction perfectly down there. That was my swing target after that divergent high hit this trend line, and we bounced. We're right about at that previous high right there, that previous divergent high right now, and that's resistance. It's a reaction high, but I have even better resistance right here at about on the euro US dollar pair 1.11560. So again, the divergence is needs to be confirmed. You need to get a bearish crossover here, a clean, clear bearish crossover on the PPO, and I think that can either come, could come tomorrow or next week. And I really see it happening, and I think it'll happen. I think it'll happen anywhere from where we're at today, and we're talking a very small amount, so that would be minimal upside there. You'll have remember, you had divergence here, and you did have a correction, and the correction went exactly where figured it would go and bounce reverse there, carried up a little higher than I thought at this point, because I'm thinking now we may take that trend line out on the next. If we get down to it again, we'll probably take it out because this is a much bigger divergent high. Now the takeaway, if you're wondering what I'm talking about, why I flipped the euro US dollar, that's a proxy. It's just the euro is inverse to the dollar. It's the biggest component at 56.7% or something weighting, and so it just moves inverse, and this is a proxy for charting the dollar. But you have a positive correlation with gold and the stock market and euro. They are all positively correlated. That's why I like to use this chart. I've showed you many times, but again, you're catching up. You just go here. Edit chart properties, there's the S&P 500, and there's let's make gold yellow. It's a little easier to see. Turn that on, and you can see they all move together. When one goes up, they're all going up. So anyways, that's what I'm looking at here, and this helps to confirm what I'm seeing. So you have that negative divergence on, as I showed you, the stock market earlier. You have it on the euro right now, and you have it on gold as well. There's GLD. You had it here, and you know what? One thing missing: it was never confirmed. It still hasn't been confirmed. Me and my quirky little nuances that's potential negative divergence when indicators are making lower highs, because they are momentum indicators. They're moving up still, and they can continue to move up, and if they keep moving up, then you no longer have negative divergence. So that's why I have that criteria, that is to see a clean bearish crossover that puts in a lower peak. You still have the divergence, negative divergence or potential divergence in the RSI down here and the PPO, but we need to see the PPO make a bearish crossover. That's going to happen if and when the euro reverses, because of that very strong and unmistakable positive correlation I just showed you. So so that's it. So gold's still in an uptrend, and once we get that divergent high, it's not a sell signal in itself, but it's pretty darn accurate when you just look at the bearish PPO crossovers here. And the easiest way is turn on the histogram, and then just take a line up. And so here is one right there, and you can see what the gold did after that. And I look for the big green clean hills. That was one, but that was a whipsaw, but you finally got it right there. And it just resulted in this whole thing was a period of really consolidation. Your correction was more in time. It kind of flattened out for a while, but there was a clean crossover, and there was the drop. There was a crossover right there. There was the drop. All right, you get the point. There was the crossover. There was the drop. There was the crossover. Mostly sideways correction there. All right, so that's that. So we'll see if we get that bearish crossover in gold. It appears likely and imminent to me, just like the stock market. And you know, patience pays. Often does. Sometimes these charts, again, I have to say it repeatedly, you know, divergences can be taken out, and then things start to change. The outlook starts to change for me. The technicals change. Silver is going to follow gold, and silver, you don't have the divergence, but you have a very steep, a dangerously steep uptrend line. You had a comparable trend line there, and remember, silver broke down first. I talked about it, but gold didn't break down to right here. Silver broke down, and just like the stock market on that 60-minute chart, it was in this, after the breakdown, it didn't immediately go down, but it stopped going up. What it did, it went in a sideways range, had one little false break there to the downside, one little false break to the upside. Then on this very day, that's when gold finally broke down its comparable support level, and then you got the big correction. We were short on the way down there, covered, and went long. And you know, I wish I was still long. Wish I could tell you I'm actually short the metals and the miners right now, but that's even better resistance. Look at that. That's a line I've had here for quite a while, about $24. Major resistance there. Pretty big, not major, but pretty good resistance on silver. And again, silver's going to follow gold. Just there's that breakdown I told you about right there. That was the breakdown in gold that coincided with that. Remember, silver broke down first, and it was waiting for its big brother gold to tell it which way to go. Silver is not going to go down that hard without gold breaking down. The gold broke down, and that was one of these lopsided trades where everybody gets cross-eyed bullish, you know, because gold's going up, and then you get too many longs in there, not enough shorts. Shorts get squeezed out, and that's usually it's a beautiful thing when you had the breakdown candle. It allowed you to get out, and if you missed it, then they gapped down the next day, and they never let the longs out until they capitulated there, and then, you know, that's how it works. All right, so we've got a gap up, a little doji there. Nothing would be nicer than a nice gap down tomorrow. This would give you an island top candlestick, so we'll see if that happens. But again, watch the euro, watch the dollar, watch gold, silver, the markets. It all is interrelated. And then last but not least, that whole vicious cycle playing out exactly as it has been throughout this bear market, and exactly how I think it'll continue to play out with the bear market rallies in the stock market, such as we're seeing now, coinciding with periods of abatement and inflation. And everyone, the market will, despite what the Fed says or does, the market assumes the Fed's going to start giving back the juice, you know, the easy money. And then by the time, you know, the market will rally on that, and then commodities will resume or start their next leg up, which they clearly have. That was big support on DJP, about $31. We had a correction in an ongoing, what I believe still to be an ongoing bull market with new highs to come, and then you rallied off there. You recently took out this downtrend line, as you can see there, and commodities continue to roar. Or move higher. I shouldn't say roar, but it's these positive divergence. So all these things tie together. They're all going into again, I'm speaking big picture. I keep focusing on those 60-minute charts because we're waiting for the next sell signals in the market, and things like gold, silver, the euro, and all that. But right now, this is where it looks like we're going. And then to just show you a couple more things here. You know, we're seeing you know, flare up, especially, you know, well, crude oil, I've covered that. USO hit that, you know, that long-term target of 58 and is up just. And see, this is the stuff. It kills me how the market is so they rally on old news. You know, the softer than expected CPI print yesterday was yesterday's news. It was this last plunge right here, last plunge down, and you've got when I look at the headlines, they're chalking it up to, okay, the inflation trade's over and the Fed won, they did their job. And you know, next thing you see, you're going to have a hotter than expected CPI print. Crude has gone up, and that's the biggest component as far as commodities go for the CPI. It's rallied 25% in just since, what is that, March 20th. So we're talking just you know, a few weeks here. 25% rally in crude oil, and it's at resistance now. Maybe a breather, maybe not. Who knows? But we'll see. Anyways, that will ultimately impact equities. It's going to impact, you know, what the Fed is going to do or what the market will think the Fed's going to do. And then just a few more to show you. You know, these commodities continue to roar. JO, coffee. Last update I gave you, we shorted Joe. We were first. We were long. We closed longs right here. This was posted back on March 16th, so not even a month ago. Before that, we had, you know, we're long off here, off that divergent low somewhere, rallied it up here. I pointed out this bearish rising wedge and gave us, you know, sell signal. Closed out the longs, reversed to short. That's missing there. Truncated. I closed the box in too much. And then that short pullback target was hit. 40, what is that? 49.48. You can see it there. And reversed to a long. So that's an objective long for the next leg up. That was then, and this is now. JO. There's that 49.48. Close enough for government work. We spiked down below it by about 2%. It's well within, you know, no reason to stop out. You know, it's almost a perfect entry. And from there, from that 49.48 level, in just a few weeks, coffee's rallied almost 17% so far, and we're coming up to my next target zone. Remember, these are just re-entry trades, you know, getting back in, next leg up in commodities. And that's Joe. What else do we have? Sugar, SGG is one of the ETFs, or you can trade. Well, that's Joe. There's KC Coffee Futures. That was back here. Same thing. I just showed you. JO is the coffee ETN. So that was that wedge, comparable wedge. We closed our longs, reversed to short, or at least posted that on the site. Hit the short pullback target, which was right here, reversed to long. And again, this was posted this same day, March 16th. Casey and Joe offer an objective long entry or support with an additional entry to come on the trendline break, and then that was then. This is now. So that's what it did. There's that buy zone, re-entry zone. We covered our short, dipped slightly below. All it did really is this was where that breakout was shown here, and so all we did, I had to roll these. By the way, if you're looking, the levels are going to be different. We rolled to the. We're now on the July contracts, and so you had a breakout. That was back then on the 16th. Back tested once successfully. Back tested the wedge again. The divergence that we had at that time on the 16th only got bigger recently, and then coffee's ripping. So this is what, again, this is what that vicious cycle to me has looked like and will continue to look like, and the market will get the memo, and sooner than later. And the longer, the more of these commodities that go up, the longer that you know, that inflation trade persists, the bigger impact it's going to be on the market. You know, if the market continues to ignore it. One more for you, and that would be sugar. You know, sugar's been covered in videos. I don't have a screenshot of a chart right now, but I talked about this trading range here. And then we broke out. We had, and this is a case, here's a good example where divergences do get burned through. You know, we had a little wedge after we had a breakout right there of that trading range I talked about. Sugar powered through, and it powered through the divergences. So now those divergences are no longer intact. Was pointed out as an objective long entry here at the bottom of that range and on the breakout above there. Now, would I buy it here? No, it's very stretched, very overbought. You know, it's gone nearly parabolic. You know, it can continue to run. I can't make a case to short it either. I certainly wouldn't short it, but I wanted to just point that out, that this is the reflation trade. You can go across down the board. and look at did I show you DBA? DBA, if you want to kind of get an idea where food prices are going, this is the one to watch. DBA is the Invesco, I guess that's Deutsche Bank Agricultural ETF, and you have everything in here: cattle, soybeans, sugar, corn, cocoa, wheat, coffee, hogs, lean hogs, feeder cattle, cotton, and again, this is something like everything else, commodities, roll back. Any chart you want to look at, any commodity index, they peaked back in 2008. Fed blew a big commodity bubble back then. We had a period of a big old bear market that ended when COVID hit back in March of 2020, and by just about every metric, taking out all these previous peak highs, we're in what appears to be early stage new bull market action. DBA, I believe it was pointed out here in 1957 as an objective re-entry. You know, like everything, it hit a target I had. This is a weekly chart, 2291, really good support. It was support, resistance right here. Support, we broke it here. Back tested, got rejected. Back tested, got rejected. That was the final leg down the bear market, and this was the initial leg up in a new bull market. First corrective wave. Right back to support, held 1957 pretty good and starting to move off it. And so the way this works is we've already checked that resistance once. So yeah, probably get another reaction, maybe, maybe not, but it increases the odds with it at the next run, reaction or not, we're going to go through there and continue on up. And then of course that puts inflationary pressures on that the Fed will have to deal with. So, and just eyeballing this, looks like I could probably draw a trend line off the highs here. Nice trend line, and yep, comes in, come capture all these reaction highs back here. Boom, 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 boom. And there was your breakout of your bear market downtrend line, just like the general commodity indexes. Remember, this one doesn't have the industrial metals, precious metals, oil, gas. It's just agricultural commodities. And that's it. So until and unless I see this whole, negative feedback loop between interest rates, real or perceived, commodity prices and stock prices, there's a lag to it, like I said, because the stock market usually doesn't get the memo or won't get the memo, because the stock market, it's, at least with this loop, it's once they clearly see the trend of inflation reemerging, and sometimes it might take these people, again, it's crazy how the market hangs on these GDP reports when you can just watch a general commodity ETF and look at the big moves. I mean, month to month, I'm not going to tell you can accurately predict whether we're going to hit or miss the consensus number, but there's quite a few months, and again, I've done this before, where you can pretty much see the big changes. These are the month. I was doing it back here for you, and I did it since these boxes that show you the month. So there was a big drop off in commodity prices, and of course, I believe that CPI came in below expectation that month. There was a big surge, and again, and there can be, and I have noted, there sometimes is about a 1 month lag, but for the most part, this is the trend. So follow the trend. If this continues, then guess what? You know what? Well, that's deflationary, and that's going to give the Fed room to, if they want, to maybe cut rates again. However, if we break out of, we broke out, but if we continue to run and start moving back up, and then it starts to become apparent that this was just a corrective wave, as I showed you, in a much larger new bull market, and then stock market ain't gonna like that, folks. All right, let me wrap it up here, get the video out to you, and let's see what the banks do. The banks are the banks. The biggest earnings to me are going to be the big tech stocks that are coming up here in just a couple weeks now. Again, the technicals, well, I showed you what the technicals are. Watch Apple. Apple still tagged that trend line yesterday. Today is just another reflexive bounce off trend line support. So again, pretty much yesterday's lows on Apple, QQQ, everything should do the trick. And if not, then watch those divergences if we keep going higher. Watch resistance levels if they take those out. Watch that downtrend line on Apple. That's a big one. primary downtrend line. But I'm going to say this, and then I'll shut up and wrap this video up. As a rule, I tend to either pass on any breakouts that occur just before earnings, or if it's as far as analysis, whether I don't have a position in Apple long or short now. I'm just in NQ. But I would also take any breakout with a grain of salt, because we're in that window. It's just like the FOMC announcements, the big meetings. The markets tend to go in a holding period, breakouts that occur right before that, and same thing with earnings, especially with earnings. So I would really, my advice, my preference is to stand clear of these fangs individually heading into earnings. Don't read too much into, again, a breakout. If we do pop this trend line right before earnings, it's just going to keep us in the wedge, that upper wedge line. Now, if they pop it and they start to take out the divergence and, start to clearly walk away from that bear market downtrend line, yeah, that starts to change things, especially if post earnings Apple is clearly above its, again, that's the bear market downtrend line right there off the highs. Numerous reactions, clean reactions. And so those are the things that will start to change my outlook. So, all right, we'll wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.